Alex, you're on the East Coast too, aren't you?
Yep, same time here in New York City.
All right, good. So we got the East Coast covered. Wait just maybe another half a minute or so, and we'll get started. All right. Looks like we have quite a few people online here. Don't want to hold anybody up. Thanks everybody for joining us on this call. Second call in a series that we're hoping will go for a while. It's what we call the multifamily commercial peer group, and thought we would talk tonight about. I had a few questions on the mezzanine financing example that we had put out a few weeks ago, and so I think we'll go over that. I'd like to go through that and just answer a few of the questions that came up in that. And I also would like, we went to this GoToMeeting platform so that people can type in any questions that they have. Really would like to be able to have this as interactive as possible. And if I can figure out how to handle the GoToMeeting control panel here, it would even be nice to be able to unmute some people and be able to have some discussions back and forth. And so any questions that anybody has, there are a couple of things I'd like to suggest. One is that if anyone has ideas or suggestions on how this might be formatted so that we all get the most out of the time we spend on this call that we can. Always open to suggestions on that, so please be sure to share any thoughts. Also, I know we have a lot of experts in the group, and certainly would like to be able to get input and training, advice, mentoring, whatever we want to call it, from anyone that's in their certain niche or area that they like to work in as it relates to any sort of commercial, whether it's self-storage units or apartments or you know, any sort of commercial type of business. So, and let's see. Oh, and then if at any point anyone has a suggestion for even a guest speaker outside of our area, certainly open to looking at that as well. So with that, Alex, you have anything you'd like to share initially, or should we go to the mezzanine financing example? What would you like to see?
Yeah, no, let's go ahead. And one other thing, if anybody has any questions also during the presentation, feel free to type them on the right. Either one of us while we're looking at, or somebody's presenting, we'll do our best to be able to answer the question, either somebody coming and asking it just by voicing it, or just writing it on the right-hand side on the chat. So other than that, yeah, let's go ahead and get started.
Okay, so I think what I'd like to do is just go fairly quickly through this presentation and then go through a couple of points that I'd like to make on it. In an ideal world, it'll take about 10 minutes for me to go through it and make some points on it, maybe 15 minutes, and then we'll go to questions on this. And then after that, I know that Andrea Trout is on the line, and she has a project, a commercial project that we were just going to share a little bit of thoughts and information on that one. And then from there, we've got a couple other topics on the burner in case we need them, or we might just shut down before the hour is up. So with that, we'll start with this example project, mezzanine financing. And this was a presentation that I did about a month ago, maybe 3 weeks ago, that showed a little bit of a unique twist to mezzanine financing. It shows how mezzanine financing works, but it also had a little bit of an extra twist that helped increase the return, the potential returns, and decrease the potential risk. So with that, let's see if I can get to making this presentation work. Okay, so just to give a quick rundown on the description of the property, it's 1,004 units. It's in Tucson, Arizona. It's actually 5 sets of buildings in the Tucson area, all in good locations. They were built between 73 and 85. The purchase price for the entire package was $45,500,000, and it was purchased at a cap rate of about 6.6% with a net operating income showing when it was purchased at just over $3 million. Conservative year 1 net operating income, that's after the first year, or at the end of the first year, estimated to be a total of $3.25 million basically. The debt coverage ratio was at 1.89, which is pretty high, pretty decent number, pretty reasonable. It has, what we liked about it, has strong stabilized income stream with a bit of value add opportunities. The management was a little bit tired. They hadn't taken care of some of the minor maintenance. So there's, with about $4,000 per unit in improvements, that would allow for about a $75 increase per month. And that increase could increase the value as much as $13.5 million. Actually, I believe we're at a little bit of a conservative number on that. But if you look at the line above that, current rents, if we're able to increase the rents, when I say we, if the borrower is able to, in this example, then that potentially just a $10 increase without any improvements, just based on it being $10 below market, per door per month, that could that would equate to about a $1.5 million increase in the value of the property. Okay, and demographics, great location, near main thoroughfares, good access to employment. Tucson is certainly expanding with a lot more residents, 20,000 projected over the next decade. Good job, strong job growth. Industry is moving in. And again, I'm going to go through this sort of fast because we do have the more detailed version, and so certainly feel free to let me know if you'd like a copy of that. We'll send that out. Purchase price $47.5 million for the entire package. For construction costs, reserves, closing costs, everything else in, another just over $7 million. So we've got about $54,500,000 total costs. In this case, there's a first position conventional financing being brought in. I don't know that it really came in at 3.75, but that's the estimated number that was projected at the time. So 3.75 first position, very conservative, well, a very reasonably priced first. And then the equity piece on it, there's a 90% of the equity, which is the remaining 25%. I'll show it to you on a chart here, but that 90% equity that it's going to take to bring in, it's going to be required over and above the $38 million. That'll be $14,700,000. That leaves 10% of the equity still required, or $1.8 million. The $1.8 million is what we're going to be talking about as the mezzanine financing. So the total capital stack came to just over $54.5 million. Estimated value with those improvements put into it as shared in the summary, after year 1, estimated conservatively, we believe, at $56.7 million, or at the end of 5 years, which this is really a 5-year play, $64.8 million roughly on the 5-year value. So the numbers, again, purchase price $47.5 million. We have total cost of $54,500,000. That's with all expenses in. And after the first year, we're looking at a $56.7 million value and a $64.8 million after 5 years. So this gives an idea of how the capital gets brought, or how the capital stack is laid out. And let me do this again. 38 $38 million is what the first position would be. That's 75% of the required capital to get the project funded. So that's $38 million. The other 25% that's needed to get this project completed is $14,710,000 plus the $1,800,000. Again, the $1,800,000 is a piece that we're talking about for equity or mezzanine financing. Let's see here, and this shows what the value would be after year 1 and after year 2, after year 5. That sliver or that slice on the right-hand side, that all reflects as the mezzanine financing plus the potential upside of the mezzanine financing. And I'll come back to that in just a little bit with a couple of the questions we had. Why we like the project? Repeat borrower. We've worked quite a few deals with this borrower. Very sophisticated team. Great track record. Their team just has had many years of experience combined. They already had the participants in place, meaning they had the 90% equity buyers. They brought the project with the 75% financing. So, and they brought the management team. So they brought everything that was needed to get this done. All they needed from us was the $1.8 million or the 10% of the equity piece that was required. We also liked it because the numbers were already good before even improvements were done. So it's already cash flowing. Stepping into something like that where it doesn't require, it's not requiring a ton of work before the cash flow starts coming in. So the amount of work that needs to be done, really very minimal disruption to the project, so it shouldn't affect the project, the cash flow appreciably. And we like this project because if we get this one figured out, we know that we can replicate it because it's quite a desirable. There's just a lot of investors looking for mezzanine financing in order to get projects funded, and so by setting the model up this way, we feel it's very repeatable. Potential risks, probably the one that I would say it's a large first position, but I'll share with you in a minute what I think is one of the reasons that even that we don't see as an extremely high risk. I think actually we see it as a pretty low risk, and I'll explain that. Other than that, we didn't, and I'd love to hear questions or comments or opinions on other potential risks, because this would be a great forum to be really testing this model to make sure that it is what we think it is. And if we can do it here online, then when we're talking to investors, we certainly should be able to do it with them as well. So what does a borrower or JV partner bring to the table? Again, this is somewhat repeated, but they've developed the project. They already brought the first position lender, the 75% financing, plus they're bringing the 90% equity partner. They have the sophisticated team, their experience. The borrower does have a high net worth. He's if I remember right in the $90 million net worth category. And I'll explain to you in a little bit the reason that they would come to us for financing on a project like this. And there's substantial collateral. There's other cross collateral that this borrower has. So the way we set up the deal, I'll go first. This isn't really how we set up. It's how the project was brought to us. 90% investor, 10% sponsor manager. Our borrower is the sponsor manager, and I'll show you how we become part of that. Single purpose entity would be used to acquire the property, and that would mean that the 90% investors would join in that entity with the sponsor manager team. So there'd be those two entities that would come together. The third line, the single purpose entity is put together for the 10% sponsor manager. So hopefully that makes sense. 90% equity investor, they are going to get, with the way the deal is structured, they get the 10% preferred return on their investment. That's the way it's structured, so that they get the 10%. The sponsor manager gets their 10% on their 10% piece of it, but they also get the override. In this case, it's projected that the cash flow should be around 13 to 14%, so the sponsor manager actually gets to make that 3 to 4% override on the 90% piece of the equity as well. Alex, any comments, any points that I missed so far, or should I keep going? Okay, I think I'll keep going. Then we have the 1% acquisition fee. Let's see, that goes actually to the group. This group, that the sponsor manager team, they will get a 1% management fee. They will also 1% acquisition fee. They'll also get a 4% property management fee. We're building in this equation, we're building in operating reserves for 12 months for 80% occupancy, and that's another item I'll come back to in just a little bit once we've gone through the whole thing. That set up, there are no liens allowed against the property, against the 90% equity portion of the property. So, but we are able to do a lien against the entity that owns the 10% of that equity. All right, mezzanine financing. Okay, so we're bringing in, the proposed structure was for us to bring in $1.8 million, 5-year equity investment loan at 10%. That's what it was projected that we would be able to get. We would also get, we meaning the investors, the lenders, this was what was requested, a 20% override, I'm sorry, 20% ownership of the sponsor manager entity. We could use ownership entity as collateral, so that brought the loan to value around 85%. So what are the sophisticated investors' goals? We always like to increase returns and reduce the risk as much as possible. How do we do that? We do it by shortening the term of the loan, and we reduce the loan to value. Those are the two key things that we did to change this scenario from a standard mezzanine type financing to a kind of a next level of mezzanine structure. The solution for risk reduction, we did use the sponsor manager entity as collateral. I mentioned earlier the borrower did have substantial cross collateral, and we set it up with a predetermined exit strategy. So I'll go into that detail in a bit as well. But really, what we're doing is we're using cross collateral property that the borrower has, and the exit will be within 12 months instead of within 5 years. So we'll be able to get the risk capital out after the first year, potentially even within 6 months, but we're saying within the first year, and we still are able to take advantage of the back end and the cash flow. Also, we are getting a personal guarantee, and a personal guarantee from an investor that has a $90 million net worth, to me, I think at least has some value to it. Last thing that they would want to do is have their credit be bad and affect their entire portfolio. So what we did by doing the predetermined, by using the cross collateral, we actually changed it from an 84.5% loan to value on the project to a 27% loan to equity, and I'm going to show you in a second how that works, actually right here. The reason we're doing it this way is that we're trying to figure out what is the risk against the investment that's being put in. So right now, with the money that's been put in to fund the deal, and what that money brings a value to the property after that money has been spent, there it shows $4.2 million in additional value by putting that amount of money into the project. Now, if we do cross-collateral value, we did the 2.5 million, a little over $2.5 million as cross-collateral value that we were able to do. Let's see. Okay, that's a question that just came in. We'll hang on to questions just for a little bit here. So the 2.55 million cross-collateral value is what's brought in, and that gives us total equity. That's the cash value of what's there as collateral in case the loan goes bad. So we just take the 6.75 million in equity. We divide in the $1.8 million loan that we have. That number, that gives us a 27% loan to equity. So basically have, what would that be, 3 or 4 times more collateral than we do loan against the property. So let's go to the total cost, $54.5 million, estimated value after a year. This chart will just show how the collateral is being handled. So the loan on the right-hand side is put in place. It gets the $4.2 million as equity, equity as collateral, I should say, plus it gets the cross-collateral property equity of $2.55 million. That together basically increase the returns and reduce the risk. It changed it from a 5-year loan down to a 12-month loan, but it still kept the upside for the full 5 years or until the property sells. So the borrower at the end of 12 months or before is going to buy that note from us or from the entity. They're going to take that over, and they are going to now get that 10% interest. But as the cash flow mentioned, as I mentioned, we continue with cash flow. We negotiated in that we would get 3% interest on the original note amount for the remaining 2 to 5 years, even though there's no risk capital left in the project. And then at the end, the equity kicker at the end, we would get 20% ownership of the sponsor manager entity. So I'll show you the number here in a second, what that comes to. So we got $1.8 million for a loan for 12 months. So year one, at 10% interest to the investor, they get, or to the lenders, us as the lenders, with $1.8 million at 10% interest, that's $180,000 in cash flow. Year two, with the and this is the number that our investors get. So this is basically a 50-50 split with our investors. So if the investors put in $1.8 million, they get $180,000 cash flow. The first year they get $27,000 cash flow for years 2 through 5, and then at the end, based on projections, they get $443,700 as an equity kicker, which brings the total to that investor. In this example, obviously it's an example and nobody knows exactly where the numbers would come, but based on projections, it shows a little over a $600,000 return against a $1.8 million loan for 12 months. So reduction, yeah, so we reduce the risk in this scenario and we increase the return on investment from a 15% return up to a 34% return projected. So with that, now I'd like to go to questions or comments. Alex, are you there?
Yes, I mean.
Okay. Any thoughts? Any comments? Any questions?
Yeah, one of the first things I like to point out in the world that we all participate, the lending world, one of the other factors in what we look into lending in multifamily or any asset that is currently producing any sustainable income at the moment of the loan, it's another level of hedging risk. Most of the loans that it's been explained throughout the educational side of the community in the loans. Most of them talked about rehab or in some of our cases new construction. But when you get to larger transactions and you get to lend money with I would call them sophisticated or accredited investors, when you get to the point of that net worth, one of the things they tend to focus on, it's an asset that are currently producing an income, and that's for the stability of their portfolio. So another way to reduce your risk within the lending space, other than what Tom, you were mentioning about, well, how do we like to not only just taking care of the downside and let the upside take care of itself, is the fact that the property is already producing a stable income. It's a multifamily properties that they have a stable income, and usually for properties like that, there's a level of increase of stability, which means that what they're looking to do is what we call in the industry to reposition the asset in order to increase the value. Two reasons they do that is because one, there is a space, or there is a I guess there is an opportunity to increase the rents based on the market itself, which exponentially, by increasing the rents, it exponentially increased the value of the property, and that's one of the reasons why most of this investors like this type of deals. So with that said, is there any other questions that Tom and I can address, or any comments, or if anybody has had any experience before in completing a loan or creating a loan against a sustainable asset, specifically in this case for a multifamily. One of the questions that I see right now, it says Bo says he's asking about the annual appreciate rate for the area. Now, when we talk about commercial, the difference between the appreciation rate for the area in commercial real estate, as we cover a little bit, or I think we cover quite a bit on the last call. But what I would say, Bo, is we're measuring the value of the asset based on what's called a cap rate. In terms of appreciation, when you have an income-producing asset, specifically in this case multifamily, since it's an income-producing, the value of the property is completely related to what is the income of the property. Now, in terms of appreciation, it's mostly dictated by what is the desirability of the area? How many investors are coming into the area to buy this type of properties? So when we look, instead of looking at appreciating rate, we're starting to look what is the availability of that asset or that asset class in that market, and what is the supply and demand. When there's a lot of demand, of course, you're going to have a lot of investors pouring their money into that type of asset, because when you have an area with that high of a demand, larger investors will look at the risk right away, and they would say, well, if this is an area that has a very low vacancy rate, that will make my investment safer, and that's when you start seeing larger investors going into that. Now, when you do that, what happens?
Alex, I was just going to say, in this particular case, and I'm not sure if the question was in this instance, I think we used, I'd have to look back, but I believe we used 3.4, and that was based on a combination of inflation and the rate of growth. So it was for the area. Again,
Okay.
those numbers were in the pro forma that, or in the analysis that we did, I believe. So, but so did you anything else on that one, Alex?
No, it's a combination, like you said, it's a combination of what's the growth in the area, because that's an estimation of what's going to be the demand for that type of product.
Okay. Okay, great. And we do have a couple of other questions here, but I want to just share 3 questions that I had gotten earlier, and I kind of thought through which were the main ones. And I'll go to see if I can do this. I'd like to get to slide number 6 if I can do that. Hang on one second here. Okay. In this slide, if you look at the top end where the 25% is, and the reason I want to share this is that the risk profile, I want to kind of show from my perspective anyway, that why the risk profile is different as an equity piece versus if it was strictly a loan. You'll see that that line, that 10% line, is actually drawn vertically rather than horizontally across the top. If it was a loan and there's no, and it's not, and that equity piece does not allow for a lien against the property, then that line would actually be going across the top or rather than down the side. But since it's going down the side, what that shows is that the risk profile of that is actually less. When you look at the capital stack, the lowest risk on that entire rectangle is at the bottom of the page. As it goes towards the top, the risk goes higher. So the very highest piece of that entire rectangle is the highest risk. Again, if it was a loan, that 10% sliver would be across the top rather than down the side. So let's say that there's a 10% reduction in the value of the property. That 10% goes across the entire top. So the equity investors are losing 10%, and the mezzanine investors are losing 10% of their investment. So I think that's a real key thing that George was pointing out at the last Platinum. That's why mezzanine financing, when it's done in a way as an equity piece, but then also laying it in as a loan plus an equity piece, that's where I think the real value can come in, not only from nice returns, but certainly from a risk reduction perspective. And with that, even with that in mind, that we didn't calculate it that way, but we could show that the loan to value on this property is actually less than the 84% that we showed there. So let's see. Yeah, so the equity investor, I just had a quick question here from Bo. He says, for clarity, the 14,700,000 equity investors, now I'm off the screen, investor is the borrower, right? No, so the borrower is the $1.8 million equity piece. That is our borrower. The equity investor, that is the group that our borrower brought to the table. They have the cash that they want to put into the project to own 90% of the project. So let's see. Then if another question here. Again, the risk profile, just to finish that piece up, we really like the cash flow. I showed that earlier. Very minimal work. Tons of skin in the game, even though the borrower didn't have much cash into it. I think they had about about 700,000 into it. No, I'm sorry. Just looking at my notes here. About 70,000 is what they have for cash into it, and that was for their attorney's fees and a lot of the soft costs that they put into it. but we felt comfortable with it because they had so much collateral into the project, plus they had a personal guarantee, and we actually get an equity position in the project. So another question was, why would a borrower do this when they have that sort of net worth and the capability? Well, when you think about it, when this model can be replicated, and if they can do it in a way where they're not using much of their own cash, they're actually getting a 1% acquisition fee in this, and that 1% acquisition fee comes to $54,000. Oh, I'm sorry, it's $545,000 is 1% of the project. So they're definitely coming out strong on that. They also get $390,000 a year from cash flow, and it's not tying up any of their own cash. They're using their equity as their skin in the game. And the last thing that I wanted to share was I talked a little bit about the 80%. 80%. I'll go to slide 10, I think it is. And come on. Okay, so on the bottom here, operating reserves for 12 months to 80% occupancy. That is so that if the occupancy were ever to drop down to as low as 80%, even though no one would ever expect, even if the economy starts to tank, it's apartments that are usually going to be doing well because a lot of people need to find a place to live, and apartments usually are the lower cost range. And so let's say the economy did go down, and or for whatever reason the occupancy did go as low as 80%, there's enough interest reserves, enough operating reserves to cover it for 12 months. So we feel that as far as being able to cover the downside of any chance of having to cover the reserves, we feel that at 80% it certainly covers it substantially well. And we have another question here from Bo. Do you know why the equity investor did not put in the remaining 1.8? This is a standard model within the apartment or the commercial industry, where equity investors want to know that the partner that they're going in with has skin in the game. So their definition of skin in the game is 10% of the project. And so because our group put together the project, brought everybody together, they were interested in putting up to 90% into the project. It's just, again, it's sort of a standard model, 90% with 10% skin by the developer partner. Do we have any other questions out there? Anybody, any other comments? Let's see. I think we got most of. Okay, Alex, any other points you'd like to make on this project?
Just other than another way to reduce the risk in the structure that it was created, it is also another way to start looking at other avenues or other markets in where there is opportunity for us as lenders. As we looked at the way the market is going and the market having some of the Y generations and the millennials coming along, it seems, and based on data we're looking at, that's an increase on the demand of multifamily, and in exchange, of course, we're going to see an increase in demand of the capital supply type of product. So,
yep, great. And we have a question from Naresh. He says, "This is 100% leverage deal for the borrower?" ? And yes, it is. And again, the reason that we felt very comfortable with it was because we feel that as long as there's very substantial skin in the game, that everybody is always going to pay attention to the project until it's completed. It doesn't always have to be cash into the deal. This borrower is putting substantial cross-collateral into the project. And by the way, the thing I didn't mention is that that cross-collateral is already under contract for purchase, and it's scheduled, I think, within the next 6 months. We anticipate that will be paid off, at which time then the investors would actually get their risk capital back, and it would move on to the remaining portion of the 5 years. So cool. And if anybody has any other questions, certainly type them in. I wanted to just touch base. Andrea, are you on the line, Andrea?
Yes, I'm here.
Hey, how you doing tonight?
I'm good. How are you?
Doing well, thanks. So you have a project that you have been working on, and just thought we would talk a little bit about. This is a project that George had brought up on his mezzanine call probably about a month and a half, maybe a little over a month ago. And I thought it would be interesting to just check in with you and see kind of when you were going through that, when you were doing the discussions with potential investors or with the borrowers, what were some of the things that, well, let's start with maybe what were 1 or 2 or maybe even 3 of the main questions that your potential investors asked you, and then what were your answers? How were you able to show them that your project was what you felt was a good investment?
Yeah, sure. So, it's different for a lot of people, and how you structured this is great for, especially people if they're coming from the community and they're used to 12 months or less loans. So you did that very well. Ours is a little longer, but we've done some tweaks to it.
Would you mind just sharing just really the basics of the deal again, just so that everybody gets a basis to work out?
That would help people. It's just under 100,000 square feet, retail shopping center in the Atlanta, Georgia metropolitan area. It's outside of downtown Atlanta. I don't know, maybe an hour, 45 minutes, depending on traffic. And it's pretty vacant. It has right now, I'm using about a 35% vacancy factor. And that's part just due because the current owner it's a short sale, so he's checked out. He has no interest in it whatsoever. All the money's going to the bank. He's on to whatever he's on to in his life, and he's just done with this property. So it's good for us in that that's a big value add play. Purchase price on it is $2.1 million. The person we're working on a joint venture with is getting that loan. Actually, there's 2 people now. Before there was 1. Now there's 2 people that are getting a loan of $1.86 million from a first position, pretty much a hard money lender out of New York. But they are holding back $600,000 of that for the possible the capital expenditures, which are in our terminology, that's a construction fund to do needed repairs to the property. And the anticipated budget for that is probably $300,000. The remaining $300,000 is for tenant improvements. So a tenant comes into a space, they want to put in certain kind of flooring, certain kind of paint, certain kind of offices, walls, whatever they need. They can get a certain price per square foot to do those improvements from the landlord. So that money is earmarked for tenant improvements as this thing gets leased up. Again, kind of very similar to what you just explained, and what Alex said, and I think this is the important point for these kind of deals versus like a new construction or a rehab loan. There's current cash flow, so even though there's a high vacancy rate right now, the property supports the new debt service that's coming in to take down the asset to purchase the property. And I love that because when we do a construction loan, that's why we escrow payments, and as most of us have probably experienced, sometimes those go long and there's not cash flow to support that. And a lot of people, especially if you're using OPM, you know that's a pain point for your OPM, for you, and explaining it for the OPM and for us as the deal sponsors. So that's why we really like this kind of a deal. There's current cash flow. As these properties get leased up, it exponentially increases that cash flow. As we increase the cash flow on any given deal, we increase the value, because commercial real estate is based on income. So when people go to buy a commercial real estate property, whether it's a 1,004-unit multifamily building or a 100,000 square foot retail shopping center, they're buying an income stream, right? Some people don't want to mess around with the work you have to do to increase the value, whether that's adding certain things to units in a multifamily property to increase the rents, $10 or $75 a month, or in our case, like clean out the trash in certain vacant spaces in our retail shopping center, do some painting, power wash the building, seal the parking lot and restripe the parking spaces with some fresh new paint, replace the landscaping, and then repair and replace the roof in sections as necessary. Because again, the previous owners, sometimes they just, you know, somebody that owns a 1,000 unit multifamily, they probably own several. They probably have several thousand units across the nation. They aren't going to pay attention to these small increases. Somebody that's losing a property in foreclosure, he's not going to put any money into our into our retail shopping center, right? That's where we can come in and create the value and gain income and gain at the same time equity. So if we have this cash flow already from day one, that's where you're protected as an investor. You know, now.
I was just going to say, from what you were describing, it's similar to the apartments where you have a tired landlord, and over the years that we've been investing, it just, I mean, that is definitely one of the ways to get what what we'd call forced appreciation without having to do a lot of work. They're tired. They aren't getting that extra $10 a month per door, like in the example I gave earlier. In this example, I'm guessing that the rents are a fair amount below what they could be. It sounds like that vacancy rate or the occupancy rate in that area, based on what you said earlier, 85–90% occupancy for that area. That's so there's strength in that. It's a, you know, I think you also mentioned that the borrower is very strong borrower. They put a good chunk of cash in. They've got a lot of years of experience, and they're willing to do personal guarantees. So it's those types of things that when you pull all of it together, it's pulling those pieces that are, first of all, I always say identify the risk and then mitigate it, right? It seems it's very basic, but it really is what it is. Identify each item that is a risk and figure out a way to cover it. So.
Yes, and one of the risk factors before was we did have a couple here in Colorado. They've owned a commercial shopping center before, and the borrowers that live in Georgia, they've done lots of commercial stuff before, but never a retail shopping center. So in the meantime, what's happened is they've kind of negotiated. There's no hard feelings on it. It just happens sometimes this way. They've brought in a guy who has a commercial retail shopping center in Georgia. He lives in Florida. He started investing many years ago in the Atlanta area. That's where he got his start and has done over 1.3 million square feet of commercial space. Very, very sophisticated, high-level investor. And he's partnering with them. He's the one that brought this first position lender. And the reason for it is because he has this other commercial shopping center in Atlanta. He's already gone through this in terms of adding the capital expenditures to improve the building. He's gotten the bids down on our Fountain Square property between 20% below what the previous bids had been, and they were shopped. They had 3 estimates. He's already gotten them down 20 to 50% on savings. So just by sheer him owning 20% of this project for bringing his expertise and the credit partner for the first position lender that can do it kind of quickly, he's saved this project money. So the strength of the team, as you were talking about your people as well, you know, your borrower with a $90 million net worth, that's very important, you know?
Right. No, some very good points there. So other items like I think the leases, making sure that the leases are strong. I think you and I talked about that a little earlier. When a new tenant comes in, it's about knowing that that tenant, not only that you get a good 5-year lease with that person, but also that party, person, entity, company, whatever it is, that there's strength behind that. So it's all those types of things that added up. If you identify where could something go wrong, where could there possibly be an issue, and figure out a way to mitigate it. And I think that's really where it's at.
And you just asked the question about, like, and I don't know on yours, and you can answer for yours, but how many delinquent paying tenants does the property currently have? And really, you know, believe it or not, at that point, there's only 2, and one of them is not really delinquent. They're just a little slow for the property manager, but they always pay. The other one is the only tenant that is really likely to leave, and it's a small 1,300 square foot space. And again, because this property is more of a destination shopping center, it's an older property, it was built in the 1980s, and it hasn't had a lot of love over the past few years. It's in a sad shape. As we improve it, a 1,300 square foot space in that shopping center, we only need about a $5.50 market rent rate plus about $1.50 in common area maintenance fees. That's like $850 a month for a 1,300 square foot tenant. If you're a mom and pop, like my mom's a hairdresser, right? So the lady that is likely to leave is a hairdresser. So that's why I'm using this as the example. My mom used to pay like $600 for her own station and now that's California. Maybe it's cheaper in Atlanta, but you could probably put 3 of them in a 1,300 square foot space, and you would have very inexpensive rent for people. It does not take a lot for people to be able to afford this space. And that's why I think it speaks to the fact that we do not have a lot of tenants in there that are non-paying, Bo. So, you know, I think that you do have to look at the strength of the tenants. You also have to look at what their lease rates are. Like there was one tenant in here that I thought for sure was not going to renew. Their lease is up in September, and we got word from the property manager they want to sign a new 5-year lease. So, you know, retired military, Air Force, very strong financials on their own, and it's a 1,300 square foot space. So again, it's not a lot of money on a monthly basis for them.
Right, right. And Bo asks, are they triple net leases?
Yeah, most of them are triple net, and a lot of them too. The other thing is they are tied to, like, if our property taxes go up as the owner, their property taxes go up. So that's something you have to really audit those leases for, and the majority of them are. And there are a few leases coming due in 2016. Like I said, there's only one of those that's anticipated to leave. The rest have been there for a long time and have all know it's changing hands and have all indicated they would like to stay in their space. And we have 2 of the current tenants, actually 3 of the current tenants that would like additional space if it's available adjacent to their property, which 2 of them have it available, 1 does not at the moment. But that's a good indication of people wanting to stay in this property, especially knowing it's going to be made more appealing to customers as we do the repairs.
Right, right. Okay. Well, thank you. Appreciate that. We're running right almost to the top of the hour here, and I wanted to just get on to one question that Naresh had asked, and that is, can you explain a lien against the entity rather than a lien against the property? So, what that means, the way what we're referring to there is, for instance, in this case, the entity that has that 10% equity, and the entity is the same entity that is getting the loan from us. Now we become a member of that entity, but we also are using that entity as collateral. So the reason being that if anything were to happen, then we get the entity that owns that 10% of the property. So it's similar to what we do in single family or regular lending projects, where sometimes if we really want to make sure we have control of the project, we will ask the borrower to sign to put the borrower will put the property in a single purpose entity. Then at the closing table, they will sign over the membership units of that entity that owns the property over to the lender. But those units will be held in a third-party escrow, and they'll be controlled by escrow agreement that says that the loan agreement must be followed. If that loan agreement is not followed, then those membership units get transferred, get released to the lender. If everything goes as planned, then that document that signs over the membership units is just it's torn up and thrown away, basically. And so yeah, so you're right. So in that case, there is no foreclosure needed. It's taken, it eliminates the need for foreclosure. What some people will say is that, well, isn't that something that's going to be contested? I would say, yeah, in certain cases, it may well be contested, but generally speaking, once there's a meeting of the mind that that's how it's going to go, it really sets the base or the groundwork for working together under that premise. If it's a borrower that doesn't have a lot of cash, a lot of times they're going to be just as happy walking away from it as spending a ton of money to have attorneys defend it. But all that being said, what we would do if it ever came to that point is, if there was any resistance at all from having those membership units signed over, immediately we would start the foreclosure process. And in that case, we're no further behind than we were by not having that entity. And so it just really, for us, it's worked. It's worked well, and it's really kept our borrowers' attention when we're able to use that entity as collateral. So let's see, is the management fee affected in case of non-performance? The management fee is really only affected by the, yeah, I guess that might be a tough one to answer this quickly, but basically it means the management fee, whether they're doing the management or someone else is doing the management, the 4% management fee is a fairly standard number. So, you know, if it's negotiated in a way where that's part of what would be affected, I don't know that I would want to mess too much with the management fee, because then the quality of the management goes down. We do have in our contract that if there are issues with the management, we have the right to assign a new property manager. So that's the way we worked around that risk. So let's see. Okay, I think since we're at the top of the hour, Alex, Andrea, any last comments before we wrap it up here? I really want to try and keep it at an hour. Alrighty.
No, I really thank you.
Yep, go ahead.
I just thank everybody for being in the call, and if you guys have any particular questions on any of this, feel free to contact any of us. We'll be more than happy to assist you.
Yeah, and I would also say that if you like the idea of having examples of projects and how they work, two things. I would suggest that you let us know that either in comments now or in emails to us later. If we like going through examples and sample deals, then I would also suggest that as each of you come across examples or samples or deals that you'd like to run through, I would say we just arrange for that before the call, and Alex or I will walk through them with you. We'll make sure that we kind of understand the basics of it, and we'll make it a call. And again, any other types of topics as well, certainly let us know. We'll try and match what everybody's looking for. So with that, I'd like to thank everybody for joining us, and until next month, which these calls are scheduled for the second Thursday of every month. At least for now, they're always going to be at 6:00 p.m. Pacific time. And thanks for your patience with that little glitch on the timing of the on GoToMeeting. But yeah, with that, I guess I'd like to sign off. Thank you, Alex. Thank you, Andrea, for participating, and thank you, Brandon, for helping out. And I guess we'll talk next time.